Welcome to LendingCon 2024 podcast, your go-to source for everything lending related. I'm your host, Dan.
And I'm Jim, and we're thrilled to be your guides to the exciting world of LendingCon, the hospitality investment development and lending conference.
That's right. Whether you're a seasoned professional or just dipping your toes into the lending pool, LendingCon is the event you can't afford to miss.
Get ready to dive deep into the latest trends, strategies, and innovations in lending, all in the heart of sunny Orlando, Florida.
We're bringing together industry experts, thought leaders, and innovators for a 2-day networking, learning, and inspirational event.
Join us on August 7th and 8th as we explore the future of lending and development at LendingCon in Orlando, Florida at the Rosas Center on iDrop.
Stay tuned for today's guest, an exclusive LendingCon interview with Mr. Lee Ferry, President, CEO, and founder of the National Tax Group.
Don't miss out. Stay tuned for our interview and reserve your spot at LendingCon.com today.
And welcome back to podcast 2024 with LendingCon. We're excited to have each and every one of you join us for today's special guest, Mr. Lee Ferry, the president and founder and CEO of National Tax Group. We're glad you could join us today.
Yes, thanks for inviting me. I'm excited to be here today.
Great. For our listeners, tell us a little bit about what National Tax Group is and what services you offer specifically for the hospitality industry.
So, National Tax Group focuses on special niche tax codes relating to cost segregation and 179D for hoteliers. And those tax deductions that we provide are done based on using engineering principles that provide tax deductions, which ultimately are tax savings for hoteliers. And these savings can be very significant. So we find that this is a very interesting space to be in because hotels are very profitable and no one wants to pay taxes. And with our services, we're able to help them reduce those tax bills.
You're right. Nobody likes to pay taxes, whether you're a corporation or individuals. We don't like to pay the taxes. That's for sure.
Right.
So for your typical hotel operator, could you explain what the 179 tax deduction is, how it applies?
Sure. 179D tax deduction relates to the energy efficiency, the green footprint of the hotel as it sits today. And so this code started in 2006, made permanent as part of the tax code, allows for a hotelier to take advantage of $5.36 per square foot upon certification by a professional engineering firm without spending any additional money on their property. The way it sits today, once certified by a professional engineer, which is our firm, will give you a certification that's an automatic tax deduction. So most hotels, around 50,000 square feet, you're looking at $250,000, $275,000 tax deduction, which is a direct reduction on their taxable income for that year. It's very significant.
Right. You mentioned cost segregation too. What's the benefit of using that?
The benefit of that is, in addition to 179D that I just described, cost segregation goes beyond that and takes a look at the components inside the building and accelerates the depreciation on those items to match the useful life of them, which is really the preferred method of the IRS. The IRS really wants you to do this because they realize that the item isn't going to stay there for 39 years, which is the default. So by going in and accelerating the depreciation, you're matching the depreciation schedule to the useful life. Gives you a benefit because you're accelerating a lot of dollars that are non-cash dollars and taking them as an expense. A lot of times you're creating a very big carry forward in some situations, which will only help you when you're ultimately owning multiple properties to save money on taxes as well. So cost seg is a very valuable tool. It's been around for many, many years. And again, permanent part of the tax code, and using an engineering firm gets you the best results. We will go in and actually spend time to find all the little things that could be moved into a 5-year asset class, which will enable you to significantly reduce your taxable income.
So this sounds like it's boilers, it's kitchen equipment, it's washers and dryers in the laundry facility, those kinds of things.
And beyond that, it actually goes into chair rails, it goes into furnitures, FF&E. Oh, wow. We're dealing with light fixtures, the wiring to those fixtures, as well as any window treatments, draperies, stuff like that, that are all considered, none of that's intended to last 39 years. And it will all be 5-year properties. Determining the cost associated with those items and classifying them accordingly gives you an IRS audit defendable report, as well as a deduction that significantly will reduce your tax liability in the first 5 years of ownership.
So the process is they contact you and then you come in and sort of like just walk through the whole property. Can you explain that process, the segregation process, a little bit more?
Cost segregation, to do it right, you need to, if you can get the blueprints, that's ideal. Cost data has to come from someplace. We usually get that from HUD closing statements. Appraisals sometimes have some costs for those. So we're looking for some source documents. And most of the time, the owners would have those, and that's our primary driver. From that point, we would do a site visit. A lot of things, we know what a hotel looks like. We get the concept. We've done many of them for these years. And over the time, we know what to look for, but we also want to do the site visits so we know each individual property's specific qualifications and where we can find additional items to be able to cost justify moving them into a 5-year category, which is the most benefit for any owner. And sometimes they just don't show up in the plans. They don't show up in appraisals. They don't show up in the supporting documents. And you see those when you do site visits. And one of the big differences between us and a lot of competitors is they just want to look at the plans and say, here's your return, here's your report back. We're saying that's not enough. You need to go beyond that because every building has its own special features, curbs or maybe fencing or maybe land improvements that really don't show up until you see it. And you want to capture as many dollars as possible. Then our engineers go through those details. And by going through those details, we're assigning costs to them. And those costs are then allocated into a 5, 7, 15-year asset classification, which any one of those classifications is a benefit to the owners.
So with the 5, 7, and 10-year plan that you're talking about there, now is that the time that they would have to get the benefits from this, or would that be the time frame they have to change this? I'm a little confused about what those time classifications are for.
So there's depreciation schedules in any property, and the property basically has a default of 39 years. Everything is 39 years unless you assign it to something other than that. And so what we'll do is go in based on the asset type and be able to schedule that same dollar amount instead of being 39 years, moving it into a 15-year amortization schedule or a 7-year amortization schedule or a 5-year amortization schedule. And those years will move up the dollars and the aggressiveness, the acceleration of the depreciation of those dollars. So you bought a property for $10 million and you're realistically going to move about 30% of that into a 5-year asset classification, which means you'll be taking about $3 million and depreciating that over 5 years versus 39 years, which is where the acceleration comes in. And the same thing for items that would be considered 7-year property, and the same thing that would be considered for 15-year properties. So you're accelerating almost 40% of the hotel in a faster period of time versus the 39 years.
Okay. And a layman assumption on that would be because that allows me to save those dollars and reinvest them on replacing that unit in the realistic time frame, not the 39.
That's correct.
That
is correct.
Simple guys.
I like this. I like the simple guys actually. Keep it simple sometimes for us. So that timeline from when they approach you and say, Lee, we want to start this process. What is that timeline for them to take advantage of that 179D deduction or cost segregation?
So to take advantage of cost segregation, you could do it almost any time. You could do it at the time of purchase. You could do it at the time you've done a renovation to the property. You could do it at the time you've finished construction and you placed it in service. A lot of cost segregation and depreciation is determined based on placed in service, which is when the business starts to operate. So it's either the purchase or completion of construction or that renovation is completed. When that's done, we would then engage the client. The work needs to be done to be able to do a cost segregation report. And to be able to do that properly, we would need to ask the client for sending us the data that I discussed earlier, do the walkthrough, and then provide them the data for them to be able to give to their CPA for ultimately processing through their tax returns. And so it can be done anytime. There's no reason to wait. It's really considered best practice.
Gotcha.
So what kind of documentation do hotel owners need to provide to you to begin this process?
Yeah, because you mentioned like blueprints and stuff like that, but what specific would they have?
Invoices, that
Invoices, yeah.
We would use an Excel spreadsheet, invoices, blueprints, HUD statements when they're working on with a general contractor. Those types of documents are our source documents. And then if the source documents are not available, we do have the ability to identify costs using proven methods that the IRS approves for determining the cost of certain components and the labor associated with them. So if it's not black and white, we're able to determine that using the engineering approach as well. So there's a lot of moving parts to it to ultimately determine the right cost associated with these items inside the building, which is the light fixtures, plumbing, FF&E, countertops. All these items, not only do they include a physical cost for that item, but there's also labor costs associated with installing those. So doing it right, you're capturing both. And some support documents have all that included, some do not. We are able to, using the engineering process, determine the labor costs as well as the material costs to determine what the proper costs and classifications would be at that time.
So I guess the involvement is partially not just on that end, but it's also on the end of how you talk to your clients about leveraging those plans to affect your financial strategy, your long-term profitability, and how to do that savings in the right way.
Exactly. I mean, the strategy here is very simple, is that they're making money. They didn't buy this to lose money. They're making money and they will be paying income taxes. If you want, the IRS approves and expects you to take advantage of cost segregation. So it's a proven method that doesn't trigger any audits. It's a proven best practice for years. And so they would like you to do that. And what you're basically going to get from this is a reduction of income tax in the current year and going forward because of moving this 30% of money into the 5 years bucket and then 10% into the 15 or 7-year buckets. You will be in effect reducing your tax liability for many years to come. So you're running a very profitable operation and you'll be able to retain a lot more cash.
So it's really a long-term profitability for the hotel owners to do this, correct?
It is. These hoteliers have an opportunity to take advantage of saving money of a bill that they would otherwise owe. At the end of the year, they turn in their paperwork to the CPA, and the CPA says you're profitable. Congratulations. By the way, you owe the IRS X number of dollars. No one wants to know what that number
Yeah,
is.
you're not
The
profitable
first-
anymore. Yeah.
And once they know what that number is, immediately they're like, how do I reduce that? And cost segregation and 179D are two tools that enable you to reduce that.
That's yeah, because nobody really wants to pay the taxes there on that. So that's great information, and we'll be right back with Mr. Lee Ferry with National Tax Group. This podcast brought to you by IHRMC, the go-to hospitality management company in Orlando, Florida, and the power behind LendingCon 2024. And we're back. And thanks again, Lee, for joining us for this podcast and talking about the profitability of tax cuts, tax programs, and the 179D program within that. So there's been a lot of information in the first half. So what are some of the common misconceptions of that, or mistakes that hotel owners make regarding these tax incentives that we talked about?
Well, one of the biggest misconceptions with regards to cost segregation is that that it will trigger an audit. And that is just flat out false. The IRS will not trigger an audit because you're doing cost segregation. The IRS expects you to do cost segregation because it's considered best practice. And again, goes back to the useful life of components. They know you're going to be replacing these. So they want to make sure you're depreciating and expensing them in accordance with the useful life of them. So the first thing everybody says is, well, if I do this, I'm going to trigger an audit. And it's just not going to happen. I mean, other things on your tax return could trigger some audits, but this in itself would not. And really, that is probably the number one fear that most hoteliers or business owners, especially if you have never done cost segregation, have. But once they do it one time and they see the benefit and they understand the process, it's almost considered routine from there forward on all future investments. So it's something that you just really got to understand. And a good CPA would tell you that it's not going to trigger an audit. So once that fear is over, the next thing is it's really your money. And to not do this and to choose not to, or be advised that there is no reason, no benefit for you to accelerate depreciation on dollars that are available to you to do so, is really going to increase your tax bill. And it's really your money that you're paying out for no particular reason. And so, again, taking advantage of a code that has been there forever, it's time tested, it's proven, using the engineering approach is considered the number one safest way to do it. You're leaving money on the table by not doing it. And a lot of times people will tell me that they've talked to their CPA and he's like, no, not this year, maybe next year, which that's really crazy. And if you think about it, because you own multiple properties, for those that own multiple properties, you're able to combine all your K1. So producing a big loss on one K1 versus a profits on others will all be combined on your personal tax return. So there are so many things to look at more than the individual property, in the sense that your own tax situation is important here. And paying dollars that you don't need to pay out could be used for other things in the business. And a lot of times people appreciate those savings, and those savings can be used to buy the next property, pay down debt, pay out to partners, whatever it might be. Those savings are available to you, and it's a way to generate cash flow in your hotel beyond renting rooms out.
So probably one of the biggest mistakes they would be is not to do this.
Yeah.
It sounds like this is definitely a way for saving money and, taking more advantage of the asset that you have, which is your hotel property that's there. That's very interesting with that concept there.
Yeah.
So I know legislation changes all the time, and with the tax code, it's like this year it's this, and that year it's something else. So are there any recent changes or upcoming trends in the tax law the hotel should be aware of regarding the 179D or the cost segregation?
That's a great question. There's absolutely, regarding the Inflation Reduction Act that was signed in August 2 years ago by President Biden. In that bill, he changed the amounts that the amount for 179D per square foot could go to. It's now regulated by inflation. So as inflation is relatively high, this year it's $5.36. Next year it'll be $5.68. And every year thereafter it'll only be higher. So the adapting 179D into your policies going forward and procedures when you place in service a new hotel or you renovate a new hotel, 179D is only going to be more and more valuable as time goes by. The other tax change is the lapsing of the bonus depreciation. Part of a Trump tax plan from 2017 had bonus depreciation for 100%, went down to 80%, went down to 60%, and eventually it'll be phased out. And so the purpose of that was to encourage people to buy 5-year assets, which again could be determined by a cost segregation report in your hotel. They're already in there. You already bought them. By identifying those amounts, 3 years ago, you were able to take 100% of that. Last year, you were able to take 80%. This year, you're able to take 60%. But it's still a big benefit to take that additional bonus depreciation.
So there's always the changing going on there with the different things going on.
Right.
So you said it's going to eventually phase itself out. Is that what did I misunderstand that correctly, or is that
The bonus depreciation portion, the accelerated depreciation is always there. So that accelerated depreciation is still a 5-year amortization, 7-year or 15-year amortization. But what bonus depreciation did was it took the 5-year asset total amount that the cost seg report generated and allowed you to write 100% of it off 2 years ago, 80% off a year ago, and this year 60% off of that number. So again, getting the right number in there was super beneficial, because instead of even waiting 5 years for that number, you were able to immediately write that asset.
Yeah,
And that's millions of dollars in most properties.
Right.
yeah,
Yeah.
definitely their whole operating budget's there pretty much.
So new hoteliers jumping in the pool, deciding to take advantage of these tax strategies for the first time, what kind of advice would you give them on how to begin and how to begin the process with you?
I think anybody getting into the business should first have a really good CPA who understands real estate and real estate portfolios, real estate accounting, because they're going to be a good guide to identifying best practices, which they would lead you to 179D and cost segregation. It's just a natural best practice solution for hoteliers in any real estate portfolio. And regarding that, then at that point, it's a matter of becoming comfortable with a company that has been in the industry, knows the property types, knows how to service their portfolio, and provide them a quality report on a timely basis.
Hmm.
Well, then how would they get a hold of you? What's that process with the CPA? Would the hotelier get a hold of you? What's that process like?
So our process with regards to obtaining clients is we sell direct. We have a website, www.ntgadvantage.com. We have our main phone number is 561-257-3436. We sell direct. Once we know a property is placed in service, we have a lot of list services. We do contact owners ourselves as a sales team, trying to educate as well as to provide services to people. And then we do get CPA referrals from time to time where CPAs have seen our work in the past or they refer people to us on a regular basis and they appreciate the value we're providing to their clients any way that's best.
So it sounds like you should go to your CPA first and say, "I'm going to buy a hotel. What should I do?" And if in the first few sentences he doesn't mention 179D or cost, then you just
Find somebody else
go
there.
go next door, knock on the next.
So, and follow up a little bit, if I'm a new hotelier, it sounds like with your company you have to work with hotels that are currently already operational. If I'm a developer and I'm getting ready to go in and build a hotel, would it benefit me to reach out to you ahead of time, or is it best to wait until the hotel is built and then contact?
So the report can only be used once the building is placed in service, completed or purchased, right? And so for that to happen, the building and project has to be completed. If we contacted earlier, and it does happen that people ask us for what does the depreciation schedule look like? What do you think we can move to a 5-year, 7-year buckets? So we do get those questions and we do planning on properties. And that's also helpful as far as for loan approvals. That's very helpful regarding any sort of investment decisions. So we're able to provide that kind of guidance in advance. And it would obviously be preliminary, but the idea behind that would be to show an example of what the depreciation schedule would look like, and then the tax savings that would be generated from that.
Could that be used into a lending concept? Let's say if I'm going to a bank trying to get extra lending, if they come in to you and the building's already built and they're trying to do a refinance, would your reports in the 179D help them in a refinance?
It would, because one of the things that is in the loan process that's an add back is depreciation. 179D and cost segregation are both depreciation expenses. So you're looking at add backs. But the benefit of doing those services is an income tax cash savings. So the retention of cash in the business, in the entity, buying that property or operating that property is a value, perhaps a loan covenant requirement that's also part of the business. So we're able to show somebody as a direct add back, as a non-cash expense, an add back that could only facilitate and improve ratios.
That's good to know for this. I know we have a lot of people that are I'm in that refinance process. We got a couple of hotels that I know for a fact are in that refinancing, and I don't know if they've looked at this. That may be something that they can pick up while they're at LendingCon and see if that's a potential for them when they go into refinance. So
It is. And like as I said, it's as an add back. Bankers are not going to look at this as negative. They're going to look at it as positive because they do know it's best practice. They do know the benefit of this is a tax savings, it's a cash savings, real cash. It's a bill that you're owed to the IRS based on a successful operation, which the bank expects you to have. And as a successful operation, you're going to owe income taxes. But the best way to reduce income tax is producing non cash expenses. And that's what 179D and cost segregation provides.
Stop trying to increase income and reduce liability.
yeah, that makes sense. Yeah.
So Lee, why would you encourage people to attend LendingCon? What can they expect when they meet you there?
LendingCon is a great opportunity to learn about lending solutions and lending opportunities that are out there to meet their certain investment needs or complete projects. But when they're out there and they meet with me, they're going to get an education that's beyond that. And we're trying to share with them the ideas that cost segregation in 179D enables them to generate capital within their business. They don't have to look outside that to produce tax bills, pay for tax bills. They're able to use the opportunities of these meet and greets and use the opportunity to take over some of our literatures that shows them the benefits. We can walk them through some case studies, and that opportunity may show some value propositions that they would like to take advantage of.
Great. Well, definitely, LendingCon's coming up August 7th and 8th here in Orlando, Florida. Looking forward to having you there. And those that are our listeners out there, please plan to stop by and talk to Mr. Lee about how we can save some money.
Look forward to seeing everybody there. Be a great show.
All right. Thanks, Lee. Have a good afternoon, sir.
Thank you, Lee.
Thank you. Thank you, guys.